Joining us now to discuss is Taylor Morrison Sharon CEO Sheryl Palmer. Sheryl, it's good to see you. We also got existing home sales down for the 12th month in a row. How would you characterize the state of the market right now?
Good to see you, Sarah. Thanks for having me here this morning. Yeah, the existing home sales have just come out, so I haven't had a great opportunity to look at them, but not a real surprise to see those continue to go down. Obviously, we have a number of consumers that are in their homes and sitting with very low interest rates. I think the number I saw this morning is something like 75% under 5%. So we haven't had a lot of inventory in the existing home market. You know, when you talk about the state of the market, Sarah, you almost have to go backwards and say we came into last year in a really strong, healthy market. And then the combination of just price movement that we had seen along with the increase in interest rates, as everybody knows, really changed the consumer sentiment as we moved into the middle and back half of the year. I would say the peak was probably mid-November. As we've come into this year, as I reported on our earnings, just last week, we've seen that consumer come off the sidelines back into the market. But we had, 4 or 5 weeks of, I would say, very stable interest rates, something that was much more in the low sixes, allowed consumers to get mortgages in that high 4 or 5% range. So as we've looked into the beginning of 23, it's been really, really good.
I hear two things when people in the industry talk about mortgage rates, Sheryl, which is, to your point, maybe it marks some sort of bottoming that we saw the peak in rates at 7% and things have come down. But then I also hear 6% is a lot higher than, I don't know, where were we this time last year or early, 2022? 3%, 2%. So it's still significantly
3%.
higher, which keeps people on the sidelines.
Yeah, 3%. We're comparing against an unprecedented low, though, Sarah. So I don't think we should be looking at 3%, just like we shouldn't be looking at the kinds of price increases we saw last year and think that's normal. So I think we're in a reset. I think we're in a reset both on, because when we think about affordability, it's not just rates, it's not just prices, it's truly the compounded effect. If you go into long-term averages, long-term interest rates in the 6s, 7, 8 would be considered a very good interest rate. But you're right, we had 2 years of unprecedented low interest rates, and I think that's kept inventory, out of the marketplace. But we don't really have inventory today in the new home market or the existing market. So I think the consumer can adjust to a 6% interest rate. In fact, we've seen that in 2023. And then you have the tools, we have the tools as a builder to help them with what allows them to get to the closing table with some sort of concessions. For some folks, they're really looking for help on cash to close and closing costs. Others, it's helping them buy down their interest rate.